US-based investor. So let me just quickly rephrase PFIC, Passive Foreign Investment Company, which means the US taxman sees all passive structures like a mutual fund, AIF, and so on as a investment company, and it wants to go through the structure to figure out the underlying P&L. So an Indian investor investing in Indian mutual funds doesn't have this problem. So when we submit our tax statements, we simply say, I bought HDFC Top 200 Fund or DSP BlackRock Top 100 Fund, and I sold it for 20% higher. That's my cap gains. This is the tax I'm paying. If you're a US NRI, this doesn't work like that. So you actually can't simply say that I bought this fund for 1 lakh rupees and I'm selling it for 1,20,000. You actually have to give the full statement of what that fund actually bought and sold. And mutual funds don't give out transaction statements. They only give portfolios, and that too not precise, only approximate. So only holdings above 2% and so on. So what that means is that for a US-based investor, investing in Indian mutual fund is inherently non-compliant, because unless the mutual fund shares the full history of transactions, they can't comply with their own regulations. Long story short, most Indian AMCs simply say no to North American investors. That's draconian, but that's, I guess, how the tax. So a lot of my friends actually told me, so my graduate friends, friends during graduation, IITB friends, who said that we want to invest, but we don't really want to either go through the hassles of checking individual stocks. So we don't want to invest through stocks necessarily ourselves, nor can we invest in mutual funds. So we just left with investing in ETFs, which are listed in US for India, which just 1 or 2 of them at most. So that's a very sorry state of affairs, especially in an economy like India. It's so interesting and high growth. For US NRIs not to have access to the funds in India is quite problematic. PFIC itself, however, clarifies that it has no problems with the stocks and bonds, direct stocks and direct bonds. So if you actually don't hold a fund, but actually own a company. So the P of PFIC stands for passive. So what is an active company? Essentially is anybody like Infosys or Reliance. They're all active companies in the sense that they don't have financial income as the primary income. They're simply operating companies. So that's fine. From PFIC regulation doesn't go below that. The balance sheet and say what is Infosys buying and selling. They simply say bought at 100 rupees, sold at 120, your cap gain is 20. So it's almost like a PMS, if you will. So PMS is okay from that perspective. So PMS is PFIC compliant. Advisory is PFIC compliant. Any portfolio of stocks and bonds is PFIC compliant. What is not compliant is units of funds, whether it's mutual fund or AIF. They are not non-compliant. They simply have large compliance burden. So the easy answer is, can we just replicate the portfolio of the underlying mutual fund? And that's really what we have tried to do. So our summary after our analysis was that mutual fund replication is feasible, because mutual funds publish their reports of their holdings every 15 days. It used to be earlier every month, but now it is every 15 days. So you can actually replicate the fund. A lot of people do ask that, how about the fact that they keep selling and buying stocks, so you actually are going to be delayed in your purchase and sale. For better or worse, mutual funds aren't very high churn vehicles. So you won't see, anyway, a good fund shouldn't ideally churn too much, which means in a full year, if you leave aside the inflows and outflows, just think about the fund managers' own calls. It is rarely that they churn more than, say, 20-30% a year. Some of them might churn 60-70%, but it's largely static. You might buy some stock here, sell some stock there, and so on. And given their sizes, they can't just do it overnight, which means if you're 10,000 crore mutual fund scheme, you want to buy a stock for even 3% of your portfolio, it's going to be 300 crores. So you're not going to be buying 300 crores in a small stock or in a single stock in one day. For very liquid counters, you may, but for smaller ones, it will probably be a very gradual process. So one doesn't miss out too much on that. Secondly, our analysis suggests that it is actually not that much of a difference between replicated fund returns and actual fund returns. It sort of averages out. That's really our finding. So let me just take a quick question before we move forward. Can an NRI invest in MF using funds in resident savings accounts? All activities connected to resident account is Ayush's question. Short answer is NRIs have no restriction from Indian government side to invest in any mutual fund. Mutual funds are completely allowed for NRIs. It's not a restriction from Indian side that is a problem. It's the compliance with their home tax laws that's a problem. So if it's a Dubai-based NRI, zero problems. They can go ahead and buy mutual funds as they like. So US-based NRI, the compliance is higher, which is why many AMCs don't take their money, no matter where it comes from, domestic or overseas. Some other AMCs take it, but that's potentially dangerous because it's a bit of a gray area. If NRI takes NRO money and invests in mutual funds, takes it out and keeps it in NRO again, doesn't repatriate, technically the AMC can say we don't know even if he's an NRI or not. But realistically, that NRI is in violation of his home country regulations, especially if it's US, in not disclosing that they actually had this investment. And it doesn't suffice if they just simply disclose the cap gains on this MF, because the regulations there state that you have to disclose cap gains of the underlying securities that the fund bought and sold, not just the fund profit and loss. So coming back to MF replication feasibility, we tried to solve this problem by saying, let's just look at one fund and say, keep replicating its portfolio every 15 days or 1 month as it becomes available, track the performance of that fund with what is the fund performance of the underlying scheme. They're pretty close to each other. So the fact that you might be delayed in buying or selling as per the fund portfolio generally averages out on both sides. Sometimes you gain, sometimes you lose by virtue of being delayed. Right? So this won't work if the strategy was very active. If some mutual fund was buying and selling half of its portfolio every month, this clearly won't work because the portfolio would have dramatically shifted between the two dates of disclosure. Whereas mutual funds are about 90% the same between two dates, and the small variation is gradual. So how would this work? Think of it as a typical mutual fund, blue chip or large cap, 50 to 100 stocks. One may do it manually once or twice because all of us have access to it. You have it, I have it. Anybody who has a web connection has access to it, which is public information. But so what we did is automated this. So every month or every fortnight, all data that is disclosed by mutual funds is collated, put in a single database. And then from there, we can pick and choose that if you specify fund X, then we can select all its stocks. Not just stocks, it's proportion. We select fund Y, and so on and so forth, right? So what you need to do essentially is select 1, 2, or more funds, and then create the portfolio and specify the number of stocks you want to invest in, because a mutual fund may have 200 stocks and it might be too unwieldy for you to replicate that. Realistically, it doesn't really take 200 stocks to replicate the performance. You can get there with just 25 to 50 stocks are enough for most funds in the large cap space in particular. Anyway, the tail of mutual funds has like 0.5, 0.4% allocations, which doesn't materially affect the performance of the fund any which way. So that's the background. Now let me quickly switch over to the site itself, so you can actually see the whole thing in action. So what I'm sharing with you now is the website of MakeMyFund, which is what we studied in the last conversation also. What you do here essentially is, once you're logged in, you can essentially go to build new funds. First, the highest returns is basically the smart beta strategies. We looked at it last time. MF replicator is what you need to go to, which is simply figuring out build now. And it's fairly simple. All you need to do is start typing a name, your name of your favorite funds. So let's say Access Blue Chip, call it HDFC, growth opportunities. Then and you don't have to take many. You can just stick to one. I've taken these. The allocation is all relative, so you can just say this is by 40, this is 30. I'm sorry, this is 20, 20, 20. So that adds up to about 100. So even if it doesn't add up to 100, we'll normalize it. So you can just specify 1, 2, 3, 1, 2, 2, 2. They'll be in that relative proportion so that it all adds up to 100. Number of companies is a useful thing. It's important for you to select that. You can select as low as 5 companies, which is tricky, ideally not suitable. 25 is a good minimum. You can go up to 200 because that will very faithfully replicate the fund if you want to really be very particular about it, or you can stick to 40. Now, next is you simply get to the funds allocation. So when we look at these funds put together, this is the allocation. So you saw the allocation of 40, 20, 20, 20 to those 4 funds. We put them together. This is what the relative allocation to stocks is. Airtel at about 8%, TVS Motor at 7%, Bajaj Finserv at 6%, DMart at 4%, so on and so forth. This portfolio is already created. Since we specified 40 stocks, we got 40 stocks here. And the industry allocation is also clear. BFSI is 1/4 roughly, which is similar to most large caps. Manufacturing is about 15, services 15, so on and so forth. All I need to do now is save this with whichever name. Let's call it MF Demo 1, the amount you need to invest. Next goes to you can invest right away. So if you're an advisor and you want to just give it to your clients, then you don't need to invest now. You can just go to straight dashboard. But if you want to invest right away, then you can connect to a gateway through any of our 11 broker partners. As you can see here, Zerodha, HDFC, 5paisa, Angel, Axis, and there are 3 more in fact here. Edelweiss, Motilal, and so on. So you can pick any one of them, goes to that specific broker site, your account. So this is my personal account. So you can pick your specific personal account. You don't have to give those details to us. We just stay with you. You just get directed to it. Similar to how you would be on a shopping site, you'll get directed to your bank. Like that, you can get directed to your online broking account. So now I see here that I get essentially the order has been passed to the broker. And I get to see it before it gets executed like this. You don't need to manually enter the order. It's all there. So we saw 73 Bharti Airtel, 56 TVS Motor, so on and so forth. All these stocks are here. I had put in 5 lakhs, so it's about 4,94,000. These are the funds required. So if I add these to my account, then this will be a feasible order that I can execute. Currently, I'm not executing it because it's a demo order, but you could do that with this. And once you execute it, you get the confirmation in your account that this is a live portfolio now. So for example, this portfolio that we just created, MF Demo 1, you can see the status paper because we didn't put the money in. It was invested today, 18th of June. Mandate is mutual fund replication, unlike Smart Beta and so on. I put in 4,98,000. Today, obviously, I put in this amount, so it's just the same value. But the number of stocks available here, I can execute it later also with using the same gateway, or I can download it and give it to my broker to execute. I can even share it with other friends and all, and so on and so forth. So this is one cycle of how you can actually create a fund. So let me just take one question before I move to other parts of it. One question here is, we can't perform a low amount SIP. Answer is, you want to invest say 5,000, 10,000 rupees SIP, probably this won't work too well. It can still largely be tracking, but not ideally recommended. I would recommend this for amounts of say 25,000 plus. For demonstration purposes, you can do it with even 5,000 rupees. That's not a problem. But if you want to put real money to use, then 25K, 50K is a good number. And that the stocks start to match rather precisely. Sheetal's question is, we can do replica only in equity part of the portfolio, not in debt. As of today, we are doing it only in equity. The more exciting things coming up on debt side from our side. The problem is not us The problem is the markets when it comes to debt. In markets currently there is no liquidity for debt. So if I take a look at ultra short-term debt funds, 60-70% of the underlying will be incomplete, illiquid. So there's not much you can do by just listing it out. I can construct the portfolio, but you can't buy it anywhere. Secondly, the size. So a debt mutual fund, you can buy 5,000, 10,000 rupees, or even 50,000, 1 lakh rupees. But if you go to bond markets, even if you have the portfolio to replicate, and even if they were liquid, let's say GSEC fund, you'll need 10 crores to invest in that. So with debt, I don't want to digress too much, but we are bringing on some interesting tokenized technology, which will enable all this at 100 rupees for each bond, at which point then you can replicate debt funds also very closely. Okay, then the question is, can NRIs do it? Absolutely. So NRIs obviously need to have a compliant broking with any of those 11 brokers that we mentioned. But that's the only constraint. Otherwise, NRI is allowed to have equity accounts, so demat and broking. So to that extent, they're allowed to invest. One more question here is, can advisors benefit? Yeah, of course. That's the point I'm coming to next, which is, this is, while we're talking about NRIs as the primary or an important use case, this is by no means restricted to NRIs. A domestic investor can just as well invest in a mutual fund replicator. As an advisor, you can actually benefit from using this to replace the mutual fund manager and earn that mutual fund manager's fee for yourself, essentially. What I mean by that is this. So we created this fund right now, and there are some other funds in my dashboard. For example, I have these bunch of other funds I've created. So these funds all have been created by me for various different mandates. Now I can add these funds here in what is my interface as an advisor. So MakeMyFund is aimed as much as at advisors as it is at end investors. So you can create this page, through this page, manage the funds that your clients can see. So for example, I've added these many funds here, demo 11 June, let's call it XYZ, which I just created. It sort of shows up here. So these funds have been added by me for my clients, let's say. So what that means is the clients that I add through this approach. So I can add clients in two ways. One approach is to simply bring clients to the site makemyfund.in/the advisor name. So advisors who sign up with us get their own customized link, which essentially works to bring clients to their interface, which looks the same, but it has at the back end the linkage to their engagement with us. So when the clients sign up from their site starting point, it essentially becomes their client. And on the clients, then we charge 0.25 flat for all clients, whether they're direct or through advisors. But through advisor clients, we charge total of 1%, and we share 0.75% with the advisors. You can change that 0.75 to a lower number or higher number. The total number is what we'll charge the clients and give you the rest above 0.25% per year. So you can add clients by sort of inviting them here through an email, demo12345@gmail.com. When you create that, you essentially get a link. So this link you can copy and just put it an email to your client, and the client signs up. You essentially get that client gets linked to you as an advisor. So for example, I just added this now, demo12345. This is awaiting sign up, and I in the past added these clients. They already signed up, and so you can see any one client, their holdings, and so on. So yeah, this is client management, and what the clients see is this. These funds that you have put together, right? These 7-8 funds, that's what they see. So when they invest in that, let me sort of log out of here quickly and log in as a client. When they invest in that, they will essentially be investing in your fund. So you earn then on the that fund, whatever is yours. So this is the view for a client. As you can see, not much has changed except for the fact that a bunch of these things have disappeared. So now if the client, this website, by the way, is particular to you. So as you can see, I put my logo, this is a demo website. This logo will be replaced by yours. There will be MakeMyFund or plus advisor logo. When you say browse ready funds, I get to see these e-funds that have been put up by my advisor. So once I click on that, I see the performance of that fund. And if I move forward to invest, as a client, I can go ahead and invest, but the mapping will be to the advisor, the specific advisor in question. So that's what we meant by having, so this, if I say save and track to share versus invest through online broking, I can invest even through PMS if the amount invested is above 50 lakhs. So we have a sister concern whose PMS we use for that. So you can invest through any combination. Your clients can invest through any combination, and they will still be mapped to you for earning the fees. Yeah, so next question here is, can ASCII help in buying debt instruments? We are putting together two things actually here. One is the debt marketplace, which is not necessarily an NSCCL replacement. It's essentially to bring together buyers and sellers of debt as bonds, like standard bonds, 5 lakh, 1 lakh, 10 lakh face value, where people can put a bid or ask for a bond by selecting from a drop down, and they can then agree on the price there, and we'll execute the transaction for them by intermediating it. So yeah, in that context, we could do help clients in buying debt instruments. Now, the other thing we're trying to do is tokenize bonds. So then make debt instruments not accessible only at the sizes of 1 lakh face value or 10 lakh face value, but make it accessible at 100 rupees. So then clients can build a diversified portfolio of bonds for just 50,000 rupees or even 1 lakh. So yeah, that's coming up next. It's next 1 or 2 weeks, we'll be launching it in 2 stages. One marketplace and then tokenized bonds. One question here was, clients bypass advisors after signing up? No, once the client is mapped to you, the client is mapped to you for good. So the client can still go through MakeMyFund direct. So let's say a client, you send an invitation to a client signs up, and then it's mapped to you. Then the client goes back and goes to MakeMyFund.in and then logs in. He or she is still mapped to you. So it doesn't matter what the clients do once they're mapped to you. And you can let us know if you invited a client, but the client went directly. That will be a rare, because most clients prefer to have some sort of a guideline, some sort of a guiding individual to walk them through what's happening. Yeah, I think that's... one more question from Sheetal. Can we cover equity PMS? 2 answers. One, equity PMS isn't offering this through equity PMS is fine. We could actually very well do that right away. Today itself it's enabled. Equity PMSs don't disclose their portfolios as clearly, and they would prefer not to get replicated in this manner, because this intermediates the investment manager. So since we're disintermediating the mutual fund manager, since mutual fund managers don't have a choice, they have to disclose their holdings to public. PMS managers have a choice, and so their portfolios are not public; they are private. So one can't do this without their acceptance. And if they accept, then we're very well happy to replicate a mutual fund, in PMS manager's portfolio. They're okay disclosing it to us, and obviously pay them some fees earned from the clients. But that's step 2, I think. Right, then is it hard-coded that clients can't go through our portal once they sign up through us? Yes, it is hard-coded. So, I mean, they can go directly, but whatever they do is mapped to you. So then it doesn't matter what they do. They can do 2 things. So they can take the funds that you have put up for view. So for example, client sees this page. This is, I'm logged in as a client now. I say invest, then I get a bunch of options. So I can do this. But I can also go and create my own fund, like we demonstrated last week. If I do that, then at this point, we essentially charge clients 0.5%, which we share half and half with advisors. because this is the case where clients are not taking your fund, they're just building their own fund. But even then you earn the revenue on them, so long as they're mapped to you. And the mapping is a one-time exercise. So unless they specifically write to us saying, I want to be not mapped to this advisor, that's fine. Yeah, then there's another question from Vivek. To introduce this platform to NRI investors, would you have write-ups that can be shared as a series of emails, educating them and warming them to sign up? It's actually a very good idea. So thanks for the suggestion. We are obviously very open to sharing with you a lot of interesting documents as well as some short videos. Obviously, this webinar itself will be shared as a video, but that will be fairly long. We can share 5-minute videos or 2-minute videos, which quickly walk them through how this happens. More importantly, we are creating also a client app for mobile, Android and iOS, where they don't see all this jugglery. They simply see your funds that you put up and they can invest in it. So that app will be fairly simple, easy to access and store all their credentials anyway, so easy for them to access. So that we're putting up anyway, so that will help. And we'll share a set of emails that can keep clients engaged, so you can then forward it to them. It will be easier if you size it, then or better. Otherwise, it goes to sort of spam and this and that can happen. And we would much rather share it with you for you to share with clients rather than us sharing with clients directly. Listen, we can share, but they'll just say who's asking, why are they talking to us? Can we sign up our clients like we sign up clients on BSc Star MF if client is not very tech savvy? That's up to you. It's a decision between you and the client. We obviously do the client KYC. So, and the clients sign agreement with us. So to that extent, the clients are okay with you managing their holdings, their engagement with us. That's perfectly fine. That's not a problem. How do we tie up with MakeMyFund is one Vivek's question. So it's fairly straightforward. Currently, we have kept it manual, but we're going to make it also automated soon enough. All you need to do is sign up with MakeMyFund. So let me just log out from here. So you go to MakeMyFund.in, you simply see this site as it is. So you can log in, you can register if you're not already registered. You can register with an email by creating a new password, or you can register using your Google account. Either of them work. So that's what, once you registered, then you let us know through an email to the email ID I'm typing in here, which is, I think you can write to me directly as well. And at spr.rasi.in, and we'll just sort of change your status to advisor. You will see all those additional features as well. Agreements are twofold. One agreement is distribution agreement if you are not an RIA. Another one is a co-advisory agreement if you are a RIA. So, and then there is a client agreement that you can give us inputs on. We have a standard client agreement for clients brought in through advisors, as in through introducers who are not advisors, distributors, let's call it. And there's a separate agreement for clients who come through distributors who are, advisors who are RIAs. So all of that we can take offline, but just write to us saying, this is your status, this is the email with which you're registered on MakeMyFund.in. We can convert that itself into your advisor email. Right. So this question is, can IFAs replicate MF portfolio of client favorite schemes? And when client makes profit, can IFA share profit if the investment is through PMS? Yeah, I think short answer is, if we just saw here that what you replicated, if you wanted to invest in that through PMS, that works just as well. So for example, if you created this portfolio, so I'm just picking one fund right now. Some fund we created, then we created whatever demo, 3, 4, 5, 6. This amount, if you put more than 50 lakhs, then you can actually invest in this whole thing through PMS also. and then you can charge profit share on that, and we'll share. So we'll always keep only 0.25% at our end. Profit share you charge, you keep it. Fixed fee you charge over and above that, you keep it. That's no problem. Vivek's question is, can the platform be used for retail investors, resident individuals? Yes, absolutely. So I merely named this as a US NRI friendly measure because this was a major felt need amongst US NRIs. Other than that, the MakeMyFund.im platform is primarily for retail, as an individual investors in Indian markets, currently equity, eventually other markets also. So there is no restriction that one has to be resident or NRI. Both are fine, both are welcome. And their advisors, of course, welcome as well. Our preferred model is actually B2B2C. We don't want to go to end investors directly. We realize that when it comes to serious money, people don't want to just do everything on an app with nobody to answer questions if something comes up. So we want to work with advisors and say, you manage your clients. We don't want to come in the way as a tech-enabled platform to just take away your clients. We want you to do a better job of managing your clients, keep bulk of the fees, give them better solutions, and spend your time better in relationship management rather than in sort of back office work and execution and so on and so forth. Madhubam's question is, we said returns match the fund performance. Can you share the study? Yeah, we will email that in the subsequent round. Currently, it's just not handy with me. But yeah, we will definitely share the portfolio performance of our holdings and as in the replicated portfolio and the actual portfolio. How old is MakeMyFund and approximate AUM number of clients being handled? So we have about 900 plus registered users. Assets under advice is a sort of a floating number, it's about 300 crores or so currently. But that's obviously through advisors because it covers overseas as well as domestic clients. We have about 7 large institutional clients across overseas and India. So couple of biggest hedge funds in the world are, one of them is a client, and other mid-size hedge fund is also a client of ours overseas. In India, we have a couple of other institutional clients and a lot of advisor clients then. What about taxes, short-term taxes in churning? It's a good question. Again, short answer is there is a tax, short-term tax mismatch for the amount that is churned, but there is a gain in terms of long-term capital gains saved when you want to exit a scheme. So let me quickly show you how. So if you're bidder today, you have this say Axis Blue Chip you already added, then you have ICICI Blue Chip. So let's say we created this fund of 50-50 of these two. And yeah, we entered and created the fund with say 50 companies. You got some fund and you invested in this. Bajaj Finserv, ICICI Bank, Infi, etc., etc. A week down the line, a year and a half down the line, you said iPro Blue Chip is performing fairly poorly. So let me look at something else, which is Birla Sun Life Frontline Equity, and let me get rid of ICICI Blue Chip now. So this is what I want to invest in, not ICICI Blue Chip. So you see again, you have similar holdings here. The fact of the matter is, ICICI Blue Chip that you got rid of, and Aditya Birla Sun Life Frontline Equity that you have now, have 70-80% overlap in their holdings. So if you held the fund through direct fund route, then you would be booking capital gains on the entire holdings, because as a mutual fund, you exit. But if you exit through this approach, when you're just saying that replace this fund with that, the underlying will have a change of only 20-30%. So you pay tax only on that portion. The rest of it remains unchanged. And you can pay tax on it whenever you exit the full holdings, say maybe 3, 5, 10 years down the line. So you defer your taxes significantly on the switch from one fund to another. That's super easy. You don't have to even tell the MF manager because you're doing it internally at the stock level. Sheetal's question is, do you have any calculation how a direct fund expenses vis-a-vis MakeMyFund total expenses? What's the cost of MFs internally while buying the expenses? Well, mutual fund expense ratios in the direct plan will go to. So let's take a look at this from a client's perspective, right? A client pays either 2.25% for an equity mutual fund, or 1% to the fund manager, 1.25 let's say, and 1% to the advisor. Either way, it's 2.25 for the client. Now, if we take this approach to MF replication, and let's say you charge the client 1.0, we charge 0.25, so that's 1.25. Or you charge 0.75, let's say, and we charge 0.25, that's 1. And there is brokerage of about 0.1, 0.15, thereabouts, because only at the investment there is brokerage. The churn is fairly small, so there's hardly any brokerage in that. Even taking into account all of that, the client pays no more than 1.25%, even if I add GST and all that to it. Earlier, the client was paying 2.25%, even if either through broker, direct plan plus in advisor, or straight away mutual fund expense ratio. So you say the client saves 1%. Other way to think about this is, if you want to charge the client higher and the client doesn't care about the cost that much, then you say that earlier you were paying 2.25, now you pay 1.75. You already save as a client 0.5. As an advisor, you can charge 1.25, we charge 0.25, rest is brokerage and GST. You're better off vis-a-vis the trail that you would earn in a mutual fund setup. The client is better off because they're not paying mutual fund fees. The only losers here are basically AMCs. Take this as a suggestion from one user, Ashi. If we forward some client details, will your time talk to them and onboard them for us? We could do that. Yeah, we do his team, so they can talk to the client. We'll have to know, however, the locus standi and modus operandi. So we'll take this offline with you. If you can email us at the address I put it here, sp@ascii.in. We'll obviously figure out the best way forward on that. Then Jiga's question is, can we import list of schemes from Excel instead of selecting it every time one by one? We could do that. We'll take that as a suggestion, and we'll enable that in our platform. STT and GST from Sheetal's side, we added that. So when I consider STT, so brokerage plus STT, when I said 0.1%, I meant on an average. So in the first year you put in, you will pay 0.25, sure. But second year, you don't churn it, as in you don't exit it. You just let it be, just follow the mutual fund. You don't pay 0.25 because you're churning at most 0.3, 0.4 of the total portfolio. So your brokerage also comes down to 0.05 or something. So on an average, it's about 0.1, and GST will be about 0.2 as well. So adding all of that together, first year will not exceed 1.5. Subsequent years won't exceed 1.25. Sudeep's question, MakeMyFund basically helps clients save more tax compared to MFs using tax loss harvesting. So that's a little bit more complex, but I will quickly mention that on the side. So this specific presentation is not about tax loss harvesting, but we can do that as well, which is make a tax loss harvesting as an additional element in what we're doing. So not only can the client save taxes at the time of capital gains through this approach, we can also benefit from active tax loss harvesting. So it's a big topic. We'll probably do a separate webinar on that another time. But in a nutshell, I can say that unlike a mutual fund here, you not only save taxes on this portfolio, you can generate short-term tax losses, which you can set off against other portfolios like debt and real estate and so on. And short-term cap gains in stocks are 15. So short-term cap losses in equities can be set off against short-term cap gains in debt, in liquid holdings, and so on. You can significantly save on taxes over and above this portfolio itself. So your yields can actually significantly jump. So in MMF, you can actually go to the extent of saving 2 to 3% of the portfolio on taxes, and sometimes as much as 4-5% if you include other asset classes for the tax purposes. So it's a whole new ballgame altogether if you really want to optimize your taxes. Yeah, I think this. So your question, Ashik, is if we can do cap gains or tax harvesting by taking profits up to 1 lakh here. We have, in fact, two things listed right here. So in the dashboard, you have something called tax saver. There are two types of tax savers that we have. Tax saver, the saver 10 is the sort that you're mentioning, which is up to 1 lakh will take out each year any which way, so that's not taxable. And there is tax optimization advanced, which is for active tax loss harvesting over and above this 10,000 also. So 10,000 very much there. So we'll do it any which way. Funny's question is, as the NRIs need to have a PIS letter to open the demat account for buying in the securities to their trading account, will all platforms tied up by you support this? We'll double check with our platforms. Most of them actually have NRIs as clients, like Motilal, HDFC, and so on. So yeah, shouldn't be a problem. But we will confirm that and let you know. And of course, these 11 are not a binding constraint for us. So if you have a broker who you want to onboard, in fact, one of the last time we did this webinar, we received one of these requests that somebody wanted to onboard Prabhudas Liladhar as a broker, and we are going to talk to them to see if we can add them in our list of brokers. So it doesn't have to be just 11. After 2 years, there will be more like 25. Everybody who's a broker should be there on our platform. Vivek's question, can we have a recording for this session? Of course, we're recording this. So at the end of it, we will summarize it and send you an update email, which will have the link to the YouTube link for this recording. Great. So let me quickly take stock here then. What I wanted to clarify was that as a user, you can simply build the MF applicator portfolio the way we discussed, not just one fund, but many funds. Secondly, as an advisor, you can actually, once you sign up with us as an advisor, you can actually have your own site. So I'm just testing here. This is a demo site, but this sort of a site which you can have feature your logo and funds that are put up by you for viewing by clients. So yeah, I think I would love to have you sign up with us and explore this in greater detail. Please feel free to add any questions before we close it in the next few minutes. We'll also send a recording, by the way, of the last time's webinar, which talked about specifically advisors, how they can onboard clients, how they can create portfolios, so on and so forth. So that comprehensive for participants who joined this time but couldn't join last time. Great. So I will check for one or two more questions before we call. And let me just quickly scan through earlier questions if there are any missed ones. Great. I think we solved most of those, as in we answered most of the questions. So I will take these suggestions on board, a couple of the suggestions which have come our way. And I'll also have the team send out the recording of the sessions. We would love to engage one-on-one with all of you as and when you decide to register and want to convert your account into an advisor account. And we can explain further as to what all is it that you can do through demonstrations as well as additional discussions. So next is, so not this today, but in a couple of weeks, we'll also be talking about bond purchases and bond tokenization, and how you can actually create a diversified bond portfolio uh, for for your clients. Shita's last question was some calculation direct and regular funds. We'll include that also. So you can compare MMF with direct funds as well as regular funds. So with that, then let me thank all of you for joining on the call at the webinar, and look forward to talking to you offline as well. Thank you so much. Have a nice day.